$8 billion in customer deposits, money meant for college tuitions, down payments, and retirements, evaporated from the ledger in exactly 72 hours. Bernie Madoff spent the better part of 2 decades systematically extracting $17 billion from his clients. This operation managed to siphon half that amount in roughly 3 years. At the center of the extraction was Sam Bankman-Fried, a 30-year-old math prodigy who favored cargo shorts and a gray t-shirt. The collapse of his cryptocurrency exchange, FTX, was initially reported as a chaotic market accident. A forensic audit later revealed a highly calculated traditional financial Ponzi scheme, accelerated by the speed of modern software. Bankman-Fried was born to 2 Stanford law professors and studied physics at MIT. Silicon Valley and Wall Street looked at this academic pedigree and consistently awarded him their trust without conducting basic financial verification. After an initial stint in quantitative trading at Jane Street, he launched the FTX crypto exchange to capitalize on the euphoric bull market of 2021. To normalize the offshore exchange for everyday retail investors, FTX initiated a mainstream promotional campaign. They spent $20 million on a single Super Bowl advertisement featuring Larry David, alongside equity deals with athletes like Tom Brady and Stephen Curry. Meanwhile, in Washington, Bankman-Fried donated tens of millions to political campaigns and heavily promoted effective altruism. He positioned himself as the sole responsible adult in a largely unregulated asset class. The unpretentious, altruistic persona functioned as an effective diversion. Investors and regulators substituted his elite background and public charity for actual due diligence. The structural vulnerability of this empire originated inside Alameda Research, a separate crypto hedge fund run out of a Bahamas penthouse by Bankman-Fried's inner circle, including its co-CEO, Carolyn Ellison. Alameda operated with no formal risk management and no independent oversight. When the broader cryptocurrency market crashed in 2022, Alameda's reckless, highly leveraged trading bets failed, leaving the fund insolvent. FTX created the FTT token out of thin air. By strictly controlling supply, they artificially pumped its market value. Alameda then placed billions of this inflated token on their balance sheet, using it as fabricated collateral to borrow real cash from FTX. The entire multi-billion-dollar valuation rested on a circular accounting trick. The enterprise was propped up by a token whose price was dictated entirely by the entity issuing it. If Alameda was effectively bankrupt by mid-2022, they still needed liquid capital to purchase $256 million in luxury real estate and sustain massive political lobbying efforts. The money had to come from somewhere. The forensic investigation eventually uncovered a hard-coded digital backdoor. Bankman-Fried directed his engineers to grant Alameda's specific trading account a secret exception, allowing it to maintain a negative balance of effectively unlimited size. FTX publicly marketed a highly sophisticated automatic liquidation engine designed to protect customer funds. The backdoor bypassed this engine entirely, allowing Alameda to silently drain segregated customer deposits without triggering internal alarms. Bankman-Fried built a bespoke financial machine designed for a single purpose: to systematically siphon user deposits into a private black hole. The structure remained intact until November 2, 2022, when CoinDesk published a leaked balance sheet from Alameda Research. The document proved that Alameda's $14 billion asset base consisted almost entirely of FTX's illiquid FTT token. 4 days later, Changpeng Zhao, the CEO of the rival exchange Binance, publicly announced his intention to liquidate his firm's $500 million position in FTT. This dual-access chart maps the resulting death spiral. The line spiking upward represents $6 billion in panicked customer withdrawal requests hitting the platform over 2 days, while the baseline crumbles as the value of the FTT collateral drops towards zero. In the middle of the crisis, Bankman-Fried published a tweet stating, "FTX is fine, assets are fine." He knew the funds were gone. He halted all withdrawals shortly after, and the company filed for bankruptcy. A system built on the illusion of infinite liquidity shatters instantly the moment transparency forces it to settle its actual mathematical debts. To manage the wreckage, the bankruptcy court appointed John J. Ray III as the new CEO. 2 decades prior, Ray had overseen the unwinding of Enron. Ray reported a complete absence of trustworthy financial information. A global corporation handling $32 billion was tracking its accounts on software designed for local small businesses, and executives were approving multi-million-dollar disbursements via auto-deleting signal chats. The inner circle faced swift legal consequences. Former executives, including Caroline Ellison, pleaded guilty and testified for the prosecution. A federal jury convicted Bankman-Fried on all 7 counts of fraud and conspiracy, resulting in a 25-year federal prison sentence. The futuristic facade of a global crypto exchange eventually peeled away, revealing the painfully analog reality of corporate negligence and classic theft. The intense media focus on venture capital failures often obscures the actual casualties. Millions of ordinary retail investors across the globe watched their life savings evaporate because they trusted the promotional hype. Financial complexity functioned as a deliberate shield in this operation, leveraging technical jargon to obscure deep structural rot from public view. The baseline infrastructure of traditional finance exists for a reason. Strict regulatory oversight, independent accounting audits, and verifiable proof of reserves are non-negotiable requirements for any institution holding customer assets. If a financial ecosystem requires you to rely entirely on the presumed genius of a founder, rather than verifiable math and legal audits, you are no longer participating as an investor. You are the mark.